Welcome back to Factful Finance. Let me ask you something. What if I told you that it's possible to make smart investments that are both low risk and high growth? Sounds like a dream, right? But it's not. Today, we're diving into exactly how beginners like you can start building wealth with investments that won't keep you up at night. So let's get to it. When most people think about investing, they imagine sky-high risks and market crashes. But what if you could build a strong portfolio while keeping things steady? The trick is to balance risk and growth. Sure, high-risk investments may offer huge returns, but they also come with the possibility of losing big. As a beginner, you need to start slow and steady. The best part? There are investments out there that give you both, lower risk and strong potential for growth. But before we dive into specific investment types, let's talk about something important. The best way to approach any investment is with a clear understanding of your goals and risk tolerance. What does that mean? It means if you're just starting out, you should focus on building a diversified portfolio, which balances both safer and potentially higher growth options. This way, even if one part of your investment doesn't perform well, the other will help protect your overall portfolio. First up, index funds. These are perfect for beginners because they provide immediate diversification. Rather than putting your money into a single stock, an index fund invests in a wide variety of companies. One of the most popular options is the S&P 500 Index Fund. Historically, it's averaged about 7% annual growth after inflation. Not bad, right? Plus, they tend to be lower risk since you're spreading your investment across multiple industries. Now, let's talk about ETFs, exchange-traded funds. Similar to index funds, but with a twist. ETFs are traded like stocks, meaning they can be bought and sold throughout the day. They also tend to be low cost and low risk, which makes them a great option for beginners. For example, a broad market ETF, which tracks the overall stock market, can give you exposure to hundreds of companies with minimal effort. And with the right ETFs, you're looking at a growth potential of around 8 to 10% per year. Next on the list are bonds, specifically government and high-quality corporate bonds. Bonds are often considered one of the safest investments. U.S. Treasury bonds, for instance, are backed by the government, meaning they carry virtually no risk. While the returns may not be as high as stocks or ETFs, bonds provide a steady stream of income through interest payments, and the risk is much lower. Depending on the bond's term and type, you could see returns around 2 to 3%, with less volatility than stocks. What about real estate? You might be thinking, but real estate is expensive. Here's the thing. You don't need to buy a whole property to get started. Real estate investment trusts allow you to invest in real estate without having to manage a property. These funds typically pay out dividends and have the potential for growth over time. The best part? They tend to be less volatile than stocks and provide a stable income stream, making them a great addition to a low-risk portfolio. So how do these investments play out in real life? Let's take Emma, for example. She's in her early 30s and looking to build wealth for retirement. Emma invests in a mix of index funds, ETFs, and bonds, about 60% in stocks via index funds and ETFs, and 40% in bonds. Over 10 years, Emma's portfolio grows at a steady pace, averaging 7% per year. While it's not a get-rich-quick strategy, Emma's careful and consistent approach helps her sleep well at night, knowing her investments are growing with minimal risk. But here's the thing. Low risk doesn't mean no risk. Even with safe investments, there are market fluctuations. But with the right strategy, you can minimize the risks while still positioning yourself for solid growth over time. That's why it's important to consult with a financial professional to align your investments with your personal goals and risk tolerance. So, what are the key takeaways from today's video? Start with low-cost index funds and ETFs to get diversified exposure to the market. Add a portion of bonds to keep your portfolio steady, and consider real estate investments through REITs for a stable income. Keep it balanced, stay patient, and let your investments grow steadily over time. Which of these strategies stood out to you? Let me know in the comments below. And if you want to keep growing your financial knowledge, be sure to hit that like button and subscribe for more actionable insights to help you take your financial future to the next level. Remember, this content is for educational purposes only. Always consult with a certified financial professional before making any investment decisions.